Rick, we hear this, coming up on Halloween, you've talked about that, the goblin of demand destruction. Are we facing demand destruction?
So in some places there is. I mean, pricing, companies have what is extraordinary pricing power today, because the demand function in the economy is so strong. I mean, we were looking at some numbers, as you were saying. You think about during this 2-year period, there would been almost 2-year period of COVID, where consumers have actually underspent relative to what they have historically. They haven't gone outside. They have underspent. We took those numbers and looked at it relative to the $2 trillion stimulus that came in. The demand is extraordinary that's out there, but companies now have pricing power, and you're seeing prices move significantly higher. You're seeing places like energy where there's a supply-demand imbalance, a significant proportion driving energy prices higher. So it will denigrate some of this demand. You're seeing in housing very clearly that market tends to slow down. People stop buying housing, you just slow down for a period of time. That is some demand destruction taking place. Some parts of consumer durables, when you get significant price increase because of supply chain shocks or energy or input cost shock. So there is some demand denigration. That being said, I think what happens over time is that some of this inflation starts to calm down. Some of the supply chains reopen. You'll get CapEx. You're seeing rig counts go up. You're seeing productivity increases in energy. So you'll bring down some of that inflationary impulse, similar to what the Fed has described. And I think the demand is incredible and will continue. But there is definitely what people describe as stagflation, I think is misoriented. The demand is tremendous. But no doubt, people will hold back in some areas because they'll anticipate prices coming down.
And it's not just, of course, for goods and services, it's also for workers. I mean, because we have a lot of job openings out there. It's come down a little bit, but it's still up near record levels. What about that? What's going to correct that situation?
David, I think I've studied this back to World War I. I don't think we've ever had a hotter jobs market. And I think, you look at just the sheer magnitude of the hiring, the Amazons, the Walmarts, 100,000, 150,000 jobs for people they're looking for to fulfill these roles. And then you look at biotech and you look at technology. I think we're going to go through extraordinary. I think you're going to see historic levels of low unemployment because there's just not enough people that are out there. And it's interesting. I watch what's happening in hospitality, restaurants, which is oftentimes the frictional job that's out there, tends to be not the highest paying job. And I think it's hard to bring a lot of those workers back because there's so many jobs available in other areas. So I, quite frankly, am not watching the payroll data as closely as I am some of the job openings data, the JOLTS data, et cetera. And it's going to be high for a period of time. By the way, you see more people retiring recently, and that's taken a lot of people out of the workforce. So I think there's a supply of human capital shortage that's going to be there for an extended period of time. It'll keep wages buoyant. And by the way, not just direct wages, but benefits and other forms of accommodation to workers that are going to be, I think, historic.
So, Rick, you say you pay more attention at this point to the open jobs than to the unemployment. You're in good company because the San Francisco Fed, as you know, did a study on this and basically said instead of looking at unemployment when you're figuring out if there's labor slack, when you're addressing the question of potential inflation, you should be looking at the ratio of unemployment to open jobs. If you look at that, that might indicate we may have some wage inflation coming.
Totally agree. And by the way, I also look at quits to layoffs. So you look at the number of people, why are quits to layoffs at historic highs? It's because job mobility is at an extreme level because there's so many jobs available that pay higher wage or better benefits, et cetera. So I think those metrics are much more important today. And so, looking at the whole suite, when people say, my God, like last month, that was a slower jobs number, the economy must be slow. It's just absolutely misplaced. It's the demand it's high. It's trying to get that supply moving into the right place. I think you're going to see more and more people come out of retirement, B, join the workforce. And by the way, it's missing that the benefits that people received, that largely expired was an immense number that expired in August, September. And so that'll cause some re-entered in the labor force, but there's still not enough people available for the jobs. So I'm watching those openings and the quits to layoffs and a series of those metrics to see where we're going. But there's no doubt in my mind, wages will be strong for a period of time.
And this all necessarily leads back into questions about rates as a practical matter. And you've said you expect nominal rates to go up. At the same time, with the inflation we're talking about, real yield is really staying surprisingly low. How concerned should we be about that? Because I've read some macroeconomists that say if you have real yield really low, it's hard to have the productivity gains.
So listen, I think looking at real yields exclusively is an archaic concept in a number of ways. Unless real yields are moving, real rates are moving to extremes. Like you go back to the 70s and you had inflation, you had to have real rates that came down significantly. And listen, I think there's something that's really important. I look at the company's return on invested capital versus their weighted average cost of capital. That drives financial transmission. That drives investment. And today, companies' return on invested capital is extremely high. You're seeing companies throw a 15, 20, 25% ROE return on equity, and their weighted average cost of capital is really low. Their cost of equity, because of how high the stock market is, their cost of equity is cheap, and the way they finance themselves, the real rates that the Treasury market trades at, it's not really relevant. It's where they finance themselves. And today, on the debt market and the equity market, there's a historic bid for yield in the market that's not going away anytime soon, somewhat because of the demographic, somewhat because of what the Fed did. So as long as that weighted average cost of capital stays reasonable, and we think it will, rates will move up a bit from here. I still think front end, short end interest rates are going to move up a bit. But boy, as long as companies continue and the demand continues to be what it is in the economy, I'm not that concerned about small moves in real rates. Listen, if inflation moves dramatically higher and the nominal interest rate moves significantly higher, forcing up companies' cost to borrow, that's significant. But I think we're far, far from that.
So, Rick, you invest an awful lot of money on behalf of an awful lot of people. Give us some investment advice here. I'm not going to ask you specific stocks or specific bonds, but tell us about what we should do with all you've said in terms of investment, and particularly because you're on both sides. You swing both ways. You're a twofer here, right? You handle both the fixed income and the equity side. What does all that tell us about, for example, the balance between fixed equity and fixed income, and equities?
So first of all, I think you got to look at companies' operating leverage and think about what this means. Do I want to be a lender? Do I want to buy their bonds or do I want to buy their stock? So what happens when you get inflation higher, and if companies have pricing power in their business and they can price it through, many of their expenses are fixed. So you think about it, they sign long-term leases, that's a fixed expense. It's not subject to inflation. A number of their expenses are fixed. So what happens is if you get pricing power and some portion of your expense is fixed, and so all you're doing is your variable costs go up, you're actually benefiting. So meaning, what do you do with all that? Equities are a whole lot more attractive than, given what we described around real rates are historically low. They can move up a bit, and inflation may push interest rates a bit, and the Fed pulling back a bit, and I think going to raise rates in 2022. Your return on a lot of the fixed income is not that interesting. Some of the credit markets, some of the real estate markets, commercial mortgages, residential mortgage financing, asset-backed financing, that's interesting if you get enough spread, and there are some places to do that today. But otherwise, I think equities make a whole lot more sense. I think the equity market's going higher. And then you hold some cash, and then in fixed income, where are you getting enough yield to make that makes sense relative to where interest rates, where the risk-free rate is, where the Treasury rate is. And there's still a number of places to do that. But I will tell you, your return is going to be driven from equity, private equity, venture capital, and that's where I think the real upside is certainly over the next year or so. So
I just want to come back and hit one point here. As you said, overall, it doesn't look like fixed income is that attractive, but there are some opportunities. You said credit, and was it high yield? Where are the opportunities you think potentially in fixed income?
Yeah, not to get too nuanced around specific areas, but places like in European high yield rates have backed up significantly recently, and credit spreads have backed up. So there's some opportunities there. I think the high yield market generally, because rates have moved up and high yield assets have cheapened up somewhat, I think there's some opportunities in high yield. The more interesting place for us today is actually to finance, it's some of the less liquid assets in residential real estate, commercial real estate, where you can actually, if you're willing to take some risk and a bit of illiquidity, that's been more attractive.